Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management. Hello, everyone. Welcome back to another episode of Blind Spots. In today's episode, we are talking all about the cost of doing nothing, or the cost of your decisions. We know that there is a price to pay for every decision that you make, whether that's big or small. So this episode is for those who are looking for an advisor. If you are working with an advisor, but you tell them what to do, you override their decisions. Or if you are someone who wants to hire an advisor, but you are not interested in paying a fee or don't see the value in paying a fee to a professional investor. So where did this episode come about for you?
So I think the last point is probably the majority. People that want to hire an advisor, or people that need help and have explored the possibility of hiring an advisor, but they're really hung up on fees, which, if you've listened to us in the past, we're a big proponent of understanding your advisor fees if you're working with one, or if you're considering hiring one, understanding how they get paid. That's table stakes. That's 101. Every advice-seeking person should have that conversation. However, I find the people that really need advice, that are fee sensitive, maybe they've worked with Vanguard or a low-cost leader, they're fee sensitive, they tend to obsess over the fee and think it's a waste of money, or I'm not paying an advisor X amount when I could potentially do this myself, or it's not that complicated what they're doing. And to that, I would counter with, that's fine to feel that way, but know that every decision that you make has a cost. Nothing is free. And I'll give you an example. So we meet these prospective clients that come through our marketing funnels and click on my blogs and want to talk to us. And this is not everybody, but this is some people that, again, don't see the value in what an advisor brings to the table, but they want advice. They essentially can't get over paying for advice, but on the back end, they might be sitting in all cash. They sold at the market bottom and have been waiting to get reinvested for months or even years. They cannot make a decision. They're paralyzed by indecision, and they swing their allocation wildly from 100% stocks to cash, and they try to jump back in. They're so close to the money because they understand the grit, the work, the sweat, the years that went into building their nest egg, and they can't think clearly. They're making emotional decisions. And that's okay if you recognize it, but oftentimes you don't recognize it. And then you just go in this negative feedback loop where I need advice, don't want to pay for it. And you keep making these decisions that are destructive, but you're not quantifying the level of destruction. There's a monetary price. There's a real dollar cost to making these emotional decisions. That's the origin of this podcast.
So talk us through some of the more common themes that you see with prospective clients, say over the last 2 decades.
I have to be careful because that's a bit of a loaded question. But in general, people with wealth are good at something. Oftentimes they're very good at something. And what makes you a great doctor? What makes you a great surgeon? What makes you a great athlete? What makes you great at whatever you do doesn't necessarily translate to investing. So again, you're talking about people with higher than average intelligence that are very good in their sphere of knowledge. However, mistakes can happen when they throw everything in that sphere of knowledge and make decisions outside of their scope of expertise. And look, good investing is not overly complex. Like, we're a fan of saying simple beats complex, and there's empirical evidence to back this up. But what is difficult is the behavioral side. Money is emotional. We have money, we have opinions, narratives, predictions, advice, market information coming at us 24/7. And if you have biases and you don't understand them, if you have blind spots and don't understand them, you are not on a good path, and you're probably going to be making these mistakes, which you might know are not optimal. But again, it comes with the cost. Like making these mistakes and not hiring someone for $8,000 a year or $5,000 a year, that could be a huge value, paying someone that to keep your plan on the rails and to keep you from making a destructive decision.
Mm-hmm.
So I've seen people where they tell me I'm not paying an advisor and I want advice. And then you look at what they've done over the past couple of years, and I've seen people make $500,000 mistakes, $1 million mistakes. And when I point this out, and of course I do it in a nice, subtle way, but direct, they refuse to acknowledge that. They always come back to what could go wrong. But yeah, if I hire this person and I get invested, I'm going to lose all my money. It's just again a negative feedback loop. They can't get out of their own way. They lack self-awareness. They're making decisions outside of their sphere of influence, and there's a cost to that.
So we talked about our pet peeves last week, and they were funny ones. One of my biggest pet peeves is hearing people chew. I hate it. It makes my skin crawl. But you sent me one of your pet peeves today that's more relevant to this podcast. So share that with the class.
So I'm 41. I don't know what a millennial is. I've heard various age ranges. I don't know what the exact is. But my pet peeve in investing, one of probably my top three, is younger people that when investing gets difficult, they sell everything and go to cash. I've noticed this more and more over the past couple of years. And I don't know, I can't quite put my finger on it. Maybe it's because of all of the meme stocks and social media culture of YOLO and trying to market time and being a market savant and making these huge active bets. I don't know what it is, but there's certainly a subculture out there that is trying to make these huge allocation changes based on what the market is doing in the short term. And I've heard some people say, like there's this one advisor that I follow, and he basically says anyone under the age of 45 should be rooting for the market to go down. Okay, now that might be extreme, but there's some merit into what he's saying, because if you have 30 years to invest or 20 plus years to invest, and you're investing in your 401k month after month after month, the market going down isn't the worst thing for you, because you're buying more shares with the same dollars. Mm-hmm. And over time, by dollar cost averaging month over month, the short-term noise in the market is going to smooth out. 99% of people under 45 would be better off focusing on their savings rate, maximizing your savings rate, because the path to wealth is not hard. It's time plus your savings rate and compounding, right? Like you add those three together and you just let it go, you're going to build wealth. The only way to screw that up is if you interrupt the compounding piece. Mm-hmm. But yet that's what so many people are doing. Like I had a call with this young woman. She was probably 41, and she had like 600,000 in her checking account. She had moved all her 401ks over to all cash, and she was paralyzed. She was rattling off these scary headlines and all this stuff. And I'm just looking at her baffled, and I'm like, you're in your own way. Like if you don't need the money, if it's in your 401k, it's in your IRA, get it invested and go focus on your family, go focus on your hobby, go take a walk. It's like you were self-sabotaging your family's plan. It just gets me worked up. I can't imagine behaving that way.
So give us a tangible kind of outcome of what that opportunity cost really is by going to cash. I don't know what her specific time frame was, but let's say someone went to cash 10 years ago. What would they have given up by doing that?
Well, it obviously depends on the dollar amount, but
sure.
There's study after study, and I'm looking for a blog that covered this, but basically the longer that you're invested, and I believe like the break even point is like over 10 years, over 12 years. It's like over a rolling 10 or 12 year period, the market has never had a negative outcome, right? So the longer that you're invested, the higher probability that you're going to have a positive outcome or make money, right? And I think after 12 years or 15 years, it's 100%. Those are pretty good odds. Sure, yeah. The short term will be swingy, but again, if you're young and you don't need the money, you're not tapping, you're not living off this stuff, let compounding do its job. Then there's also a study that says if you miss, and I forget, it's like if you miss the 10 best trading days in a year, like you basically are screwed, right? And most market timers, it's really easy to sell, but it's a two-part decision. Selling is easy. It makes you feel better. The market's going down, you sell, you stop the bleeding, you can sleep at night. What people get wrong 99.9% of the time is when to get reinvested. there's always going to be something to worry about. There's always going to be a laundry list of things that could derail the markets. And I say this all the time. If you tap the average Joe on the shoulder and ask him what could go wrong in financial markets, it'll fly off their tongue. They'll come up with 10 things that could go wrong. If you ask them what could go right, they'll probably look at you like you're crazy, and they probably won't have much to say.
Yeah.
So I found that blog post. So I wrote this September of 2021, an investor's 2 most powerful weapons. Okay. So if you're invested in the S&P 500 over 1 month, right? Any month period over the last, let's see, this is, I think over the last, like last 90 years or something, since inception of the S&P, any rolling 1 year period, what is the likelihood that you would achieve a positive outcome? I'm asking you this. 1 month.
In a 1 month period over the last 90 years, what is the chance?
Likelihood of a positive outcome for the S&P 500.
I'm going to say 85%.
That's a little high.
Too high?
That's a little high. It's
How
63.
about 60?
63%.
Second time.
63%. If you're invested over any 5-year period, rolling 5-year period for the S&P 500, guess what your probability of a positive outcome would be?
I'm going to go to 72%.
Almost 90%.
Ah,
Okay.
it's amazing.
Over 20 years, over 30 years, it's 100%.
100%. That one I knew.
So I fully appreciate the risks that are out there, but for young people to market time and start playing that game, it's absolutely dangerous. And
Yeah.
and this is going to sound funny, the worst thing that could happen to them, a 30-something that's right. Okay, let's say a 30-something sold at the beginning of 2022, went to all cash, stayed in it. They feel so good. Let's say they got reinvested in the month of January and made 6 or 7%. They're feeling like a genius. That's the worst thing on earth that can happen to them, a lucky trade, because they're going to be emboldened with false confidence. The stakes are going to get higher. The dollar figures are going to get bigger, and they're going to make a catastrophic mistake. The more active decisions that you make, big active decisions going from 0% equities to 100% equities and back, the more likelihood, almost certainty, that you're going to be crushed at some point. So young people, quit playing the market oracle. People that want advice but don't want to pay for it. Turn the mirror towards you and start evaluating your emotional disposition when you're making portfolio decisions. Be honest with yourself about what you did and when and what it cost you. And you should be able to figure it out just by looking at a chart of the markets. And know that good investing is not going from fully invested to all cash, waiting till things clear up, getting reinvested. Build a portfolio that mirrors the way that you feel about risk. Might be 100% equities, might be 20% equities, okay? Build a portfolio that reflects your investment personality, and then have a framework for making decisions going forward.
I think that was a good wrap up, kind of a summary. Do you still want to share that chart?
Okay. Yeah. So there's one chart I want to share, and Aaron's going to link the blog that I'm talking about in the notes. And no, I'm not making any of this stuff up. Like I'm leaning into market history. So like you can call me a Pollyanna. You can say that I'm delusional to the risks out there. Whatever. I'm leaning into what's actually happened. Okay. So now I'm going to share my screen, and this kind of puts a nice bow in what I'm talking about. So, Aaron,
Just to qualify before you start, for those who are listening on a podcast platform and do not see a visual, we will link to this Twitter post with the chart.
Mm-hmm.
Otherwise, it's up on your screen right now.
Thank you, Aaron. So
Please
this,
proceed.
For compliance purposes, this is from JP Morgan, and the data set is from Dalbar. So Dalbar tracks investor behavior, and they basically have access to a database that shows buy, sell decisions from retail investors at the mutual fund level. So this is a great snapshot into actual investor behavior. Okay. And it's from the period of 2002 to 2021. Okay. So all else being equal, the first half of this time period, 2002 to 2010, kind of bumpy. From 2009, 2010 to 2021, very prosperous time to be an investor. So this kind of captures both sides of the cycle, which I think is good. What this is showing is in that time period, again, from 2002 to 2021, on an annualized basis, the S&P 500 achieved a 9.5% return every year. Some years it did better, some years it did worse, but on average, annualized return for the S&P, 9.5% per year. The 60-40 portfolio, 60% bonds, 40% stocks. I believe it's 60% S&P, 40% Barclays Ag Bond Index. 7.4% a year. Okay, some years it did better, some years it did worse, but on average, 7.4% a year. Aaron, guess what the average investor performance was according to Dalbar's data set during that same time period, 2002 to 2021?
Well, I can see it on the screen, but my
Okay.
guess would have been 5% before I
Okay.
saw this chart.
So Aaron's cheating again.
Go ahead.
Aaron would have said 5%, which
I probably would have said around 5%.
she's actually
Maybe
underestimating.
4.5.
What?
Maybe 4.5.
Okay. Well, still, you're overestimating average investor skill. The average investor performance during that same time frame, 3.6% per year.
Mm-hmm.
Okay, so that
Pretty
gap,
low.
that gap is what I'm talking about. The market did 9.5%. A balanced 60-40 investor did 7.4%. The average investor did 3.6%. Okay, so all the destructive behaviors, all the emotional decisions, all of the pounding the table, predicting what happens next, all the active decisions, buying and selling and going from all cash to all equities, there's a cost. This is that cost. So think about if you had $1 million invested and you are lagging, let's just give them the benefit of the doubt, lagging a 60-40 portfolio by almost 4% a year. That's basically lighting 40,000 a year on fire every single year. And it's actually worse than that because you're taking that 40,000 and lighting it on fire when it could be invested and getting 6%. 40,000 at 6% every single year. So this would be over a period of 20 years, which is this data set. For $1 million portfolio, this would be an over $1 million mistake. These mistakes add up to real tangible drag. And most people don't even recognize it. They just say, oh, I've got, my portfolio's grown over the past couple of years. I'm doing fine. I went to cash. I feel good. It's like, no. You cost yourself over $1 million by doing not so good stuff.
That is a tough pill to swallow, especially for someone who would be gearing up for retirement and they're not sure if their money is going to last them or if they're really relying on a certain level of market returns. It's kind of scary reality.
And again, I'm not making this up. I'm not trying to disparage or berate anybody. It's just, I've been doing this almost 20 years. It's just frustrating when you see, especially young people, making destructive decisions. And most of these biases, most of this gap is explained by either FOMO, fear of missing out, which is performance chasing, or trying to avoid losses. Like you unpack any behavioral bias, and I talk about a lot of them, but almost all of them stem from performance chasing and trying to avoid losses. Those are the two most destructive behaviors on earth when it comes to investing.
Yeah, you've got a couple really good blogs that will also link about kind of the DIY investor, things that you should know if you're doing it yourself. I think that those would be helpful for those who are maybe not ready to work with an advisor or want to give it a go at doing things on your own. I think that's a good blog still to reference.
Okay, well, I'm sorry for the rant, everybody. I get pretty fired up about this stuff. I'll quit talking.
Your passion shines through. Okay, I think that was a nice episode. I hope that everyone has learned something from it and, like Nick said, kind of turned the mirror on themselves. It's always good to have a little self-evaluation and see how you're doing and check in with yourself from time to time with your own decisions. So thanks for listening to this episode of Blind Spots. As always, you can reach out to us at insight@pureportfolios.com if you have any questions, and we will see you in the next one.